Hello, 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 and we are live back again. Thank you, everyone, for joining us again. Appreciate you taking time out of your day to join us. Going over the numbers, boring but arduous job we all have to do to make sure that we make the best decisions when it comes to net lease investing. So let me run up and get my show notes. So, like every week, we're going to go through just kind of a quick snapshot of what's going on in the market as far as cap rates. And unlike other firms, we go and try to talk about it on a weekly basis. The reason why is because we have a lot of active buyers that we work with, and they just want to get a quick snapshot of what's going on so they can be able to have a little bit more insight when we start making offers or when they look at pricing their assets when it gets time to sell. Obviously, everything's in nuance. So when we have this data, we want to go into a more granular detail to make sure that where we're heading as far as making sense as far as your specific tenant or specific strategy on the buy side. We'll quickly take a look at the 10-year treasury. And again, that's just a snapshot of where we're at currently, as well as what we're looking at with any current economic data and any interesting news that pertaining to net lease investors and strategies to combat that or things that we can use in our favor that you can be able to benefit for your purchase or your sale. And then we're going to talk about how to build a resilient net lease portfolio in a volatile market. Obviously, everyone's taking a look at the news, seeing everything. You may be pro or con different things. It doesn't matter. We just try to look at the data and see what makes sense. But ultimately, the measures that we always look at as far as our investment always meets the same metrics as far as what is your goal, what do you want, what do you don't want, and try to reverse engineer to find investment assets that make sense for it. As you see on the screen, the latest book, Net Lease Playbook, available on Amazon. I appreciate everyone who's been picking it up lately. It's been picking up in sales, and we're getting a lot of feedback as far as good value. And mind you, this is about 10 years worth of transactions, investments, everything you can think of, all the different types of buyers and sellers that we've been dealing with. And I put everything in there, so hopefully it'll give you some good insight. But that's just the icing. That's just the top of the spear. We got to go do these types of calls. We're doing presentations. We're looking at data. We're going behind the scenes. That's where the education is continuing. So if you grab a copy and you want to get more deeper content to create a more value add, shoot me an email at dclark@americannetlease.com. There, we're going to be doing deep dives and leases. So we actually pull up the lease like on a Zoom call, go through different clauses, and just point things out. Obviously, I'm not going to replace your attorney or your advisor, but just having an extra set of eyes that have seen their handful of leases over their career can kind of give you some insight of what to look or what to then bring up on a conference call with your attorney. Filming our property tours behind the scenes, because obviously we like investing in net lease properties, but you also have to look at and treat it as it's real estate. We got to go there and make sure that what the broker, or the developer, or the seller is presenting to us, we have to verify, trust but verify, and talk to a lot of our go-to referrals as far as attorneys, lenders, and other investors that agree to be able to jump on calls with them and just kind of get an insight, pick their brain, so then we can learn from their wisdom and avoid any mistakes. So again, if you want access to that specialized list that we send out information about that, send me an email at dclark@americannetlease.com. And next time I'll make sure to make it a little bit easier by adding an actual link that you can click and fill out a form, so you can jump right into it. So again, I appreciate it again. Let's jump right into the data. So, and again, just as a snapshot of where we're at, is just nothing realistically going to change the overall strategy. And again, I note that in the book, but the difference of from last week to this week is essentially nothing. I think we put in another 200 data points. and we're just analyzing. Obviously, this is the top 25 tenants that we deal with. We track about 177, I believe, all the different sectors, and we're just trying to see trends. And then we couple that trend with any data that we see on the economic side, policy wise, and then buyer activity. So we're looking at transactions. We're looking at what REITs are doing, which I'm going to be talking about in a news story now about what they're doing. Because we can learn a lot about high volume transaction buyers and what they're doing and be able to get some tips or insight and a lot of good data to make sure that we can be able to be competitive and make sure that we're on the right track. So, and then again, if you need a specific broken down tenant data analysis on any of these tenants or any sector, just shoot myself or Quinn an email, and we can be able to put together what we can. Just so you can see where everything is at. I know that we send a market report every Monday, and we get a lot of good feedback from there as people are kind of seeing what's going on. Obviously, net lease is one specific strategy out of many different investment vehicles, multifamily, self storage, industrial, all these different types of things. So where does this fits in, and where does it compete? And then that gives you all of the ample um, education so you can be able to make the right move. Um, so that's just a quick snapshot there. Oh, and so we got three major headlines. And I'll try to slow down so we won't go through this information so quickly. So trending on X and some of the more shared articles is about the continuing story of the rising cap rates and interest rates. So obviously that is a big thing that people are worried about because they're trying to say, that's affecting uh, the buyer's ability to buy property. So there's also a story on, I think, quoted through Matthews Real Estate in regards to their estimation of how much equity loss in the last, I think year or so, about $300 billion in equity loss. And mind you, that's just paper losses because the traditionally where we fall in is investors are buying at 10-year terms and above, so 10 to 15 plus years. So they still have obligated lease agreements. So their cap rate, what they bought into, for example, like a six cap, is now a seven cap. So essentially, you lost value. But since it's continuing on, has contractual rental increases over the lease term, it doesn't really matter unless you have a plan to make an immediate move, like sell it right at that moment, where then, obviously pricing strategy will mean a lot in that aspect. Um, the tie-in with the cap rates, I mean, with the interest rates is now on the buy side. If you're looking to sell, it affects the ability for the buyer to come in and purchase the asset. Couple that with inventory that's on the market makes it kind of a little bit woozy for some buyers. So just you have to keep in context as far as the timing and your overall investment strategy at that time of what you're looking to do. So let me see if I can bring up some supporting article there. And this is from Globe Street. This was April 8th. So the headline is despite optimism, data suggests cap rates are still increasing. So, and I'll add a link to the follow up of this stream into the newsletter so you can take a quick look. More opinion based, has a couple quotes from Chad Kurtz over at Matthews. It's like says good data. They're also referencing about kind of pre-pandemic levels as far as when we had historical low cap rates, and people had bought in at that time because we also had low interest rates, and now are kind of saying, what's going on with the market. And again, it's an escalating, moving mark. But at the end of the day, what we teach and what we preach to our clients is this: what is your end goal? And at the time when they're working with us, they're looking to just do a 1031 out of another asset. They already have a finite mindset of where the type of NOI that they want and lease term, and then kind of continue it from there. But again, obviously, more intricate strategies as far as selling and timing the market and adding financing packages does affect that. So we'll just kind of keep that in mind. Um, so the follow up to that, just to kind of button that piece up in regards to cap rates and interest rates, is the hyper focus on essential need tenants, and just making sure that we're focusing on the things that can withstand different economic, um, we would say, recessionary periods or ups and downs throughout the market. So we want to focus on all of the intrinsics that make sense to buy these things and will last long term. So regardless if we're looking at industries like gas stations, or fast casual, casual dining, and things like that, we want to then focus on the essential needs markets and then be able to hyper focus on that, as well as the individual markets that we're investing in. Okay. Found another interesting story. I don't think I have the link here, but it pertains to retail sales, as we've been kind of seeing, of course, headlines in regards to tariffs and what we're hopefully expecting in regards to tax policies or any type of regulatory changes. Um, but the big thing is the tariff policy, and of course, people have heard yesterday, just a temporary pause of 90 days um, in regards to China, which is, like I said, a big part of a lot of the supply chain for a lot of these retailers that have a mix of essential and also non-essential goods, so that they're importing. That could affect the bottom line as far as store sales and uh, traffic to their facilities. So we want to make sure that we keep an eye on that. But as far as the counter, that is again focusing on essential tenants. So the recent conversations that I'm having still is in grocery sector, pharmacy, auto parts, urgent care, as well as services like car washes, dentist offices, eye care, and things of that nature, which have been picking up more steam as they're trying to find more resilient tenants moving forward. So just make sure, on top of that, we're going to be reviewing, which is going to be part of the presentation, is to review leases. We've been looking at a lot lately of sale leaseback transactions, and some of the reoccurring questions is, what should we be modifying or suggesting to add into the lease? Because the good thing about a sale leaseback, even though a lot of the contract is kind of set in stone as far as the framework, there's an opportunity for the buyer to come in to suggest changes to make it more favorable to them. So part of that, where I've been suggesting, is also to have an opportunity to have lease review contingencies. So on an annual basis, you'll be able to also review anything that regards to, say, store sales, as well as any type of movement as far as any type of subleasing agreements in there. Sometimes you'll have a guarantor on the lease, and because of how the market moves, the tenant might end up selling the whole business to another operator. You want to make sure that it has at least the number of guaranteed units that you bought it with, so you can make sure that it has that same strength of a financial factor moving forward, rather than kind of downgrading. So we want to make sure that you have that opportunity to look in that and to make sure that you have full protection, and lacking the exposure there. And another big story, Rich, is which I like to do because it's public, is REITs. So triple net REITs, you'll be able to see a lot of their activity. One of the largest REITs out there is, let me just pull it up, Realty Income. You have NNN REIT. They're at nnreit.com. And if you look at their latest, let me see here. You look at their latest reports, you can see that them, along with all the other central uh, REITs, have increased activity over this year. So like Realty Income up to 3.9 billion, Essential Properties 1.2 billion, WP Carey 1.6 billion, Agree Realty all up. So it's about 38% upwards. And the big thing about it is because of the lack of competition. So right now we have a lot of the private investors in the market that are facing higher borrowing costs. And then of course you have the higher cap rate. So then you have the sellers on the flip side are not getting that valuation that they want. And then right now you're just kind of stuck in the middle. But with the REITs, where they have access to a lot of public capital and then they're able to acquire stuff at a higher cap rate, they're just snatching things up. So to counter that, because I've got that question earlier, that's why I had to make sure to put this on the list, is a hunt for off market and also underwritten sale leaseback opportunities. How do you get access to that? Tap into a firm like us, or any other developers directly, or any type of sellers directly, to get access to off market opportunities, as well as secondary, tertiary markets that these REITs are not going to be accessing. So obviously that's going to be increasing, you know, the opportunities for bid wars and also pricing adjustments. So in order to kind of get in on it, if you're going to be kind of more of a volume type of investor, then that's something that you have to really consider in order to get some opportunities. So I'll be sending a link onto that so people can kind of get aware of what's going on. So it's always good, and the good thing about it is that that data is readily available. So I end up just looking through each of the trends and seeing what's really going on here. And so any type of data that I can give back to our investors to give them a little insight so they can be able to have an advantage. So 219 right now, kind of got through those pretty quickly. So let's jump into the top 5 FAQs that we got, which is kind of related to this week's news. Let's see here. Remind you, as I play show host and operator at the same time. We'll pull up the screen. Okay, first one. So in regards to the $300 billion loss in paper value, even though that's just estimation, is it a bad time to buy? No, it's always a good time to buy. And again, it's always back to what is your overall wants and note wants. Me and Quinn have these conversations all the time that we're talking to get these out of the clients, because at the end of the day, either through net lease, multifamily, small rental properties, this is just a vehicle to get you to point A to point B. So we're trying to find, and obviously this is a very favorable asset class because of the structure of it. It's absolute triple net lease. So when we're talking about the loss that we're seeing as far as overall, which is due to interest rates and borrowing costs and of that nature, yeah, we're going to be looking at the macro numbers as far as not really hyperventilating about that, but then finding out and underwriting it properly enough to find out what is the core number that this is valued at. We talked about, I think, 2 live streams ago in regards to analyzing leases and then running numbers based off the current valuation to see where the rent to sales ratio is and making sure that aligns. And then if that can keep up with where your overall goal is. So make sure just to keep an eye on that.
Just to piggyback, if this is the right time to buy, I talked to a couple investors this week, and they were asking how to navigate through the bonus depreciation law that's going to be expiring in 2027. So they wanted to know as far as if is right now a good time to buy, or should they wait to see if Trump extends that tax law. So I just wanted to get your input on that there as well.
Yeah, as far as the bonus depreciation, I have to look specifically on that. The Republicans have put out, I think this week, the tax the tax policy proposal, which they do plan on extending the Trump tax cuts all the way through to make them permanent. I'll find out specifically in regards to the bonus depreciation. I know that's going to be running out. Again, the bonus depreciation is just a tool um, to get additional tax benefits. Obviously, the cost segregation is still going to be available. The 1031 exchange is still going to be available, as well as your regular depreciation. So yeah, obviously getting as much tools and combining them is the goal, but it still shouldn't weigh on whether you should buy an asset or not. So the good thing about with net lease, we have contractual obligated lease terms. So we already know up front that they're going to have 10, 15 years on the lease. We know who's going to be paying such and such bills. So we can forecast our income all the way through from the beginning to the end, assuming there's going to be no issues with any distribution of the rent because of the tenant's position as far as remaining in business. So assuming all those are agreed to and it's going to happen, we just want to be able to say, is this setup something that I can foresee that I am comfortable with as far as the rent bumps, the long-term lease agreement, and of course the stuff that we know that's going to be moving forward, which is our regular depreciation schedule, as well as does it make sense to do any cost segregation. So we look at all the tools available in the toolbox, but at the same time, we want to make sure that is the bottom line. Does this solve my problem, or fix my issue that I want to do long term with it? So that should always be kind of the number one, and then obviously the taxes, which is significant, should be secondary. Um, but again, we just want to make sure that we're hyper focusing on what the main goal is, and then obviously add any additional stuff on top. Should I be worried about my tenant going dark due to retail slowdown? So again, this is going to be a never-ending story about the status of retail, and then we went kind of a little bit deeper last week in regards to several tenants that has been going through either bankruptcy or financial issues or restructuring. And the bottom line is, like, we just have to look at all the fundamentals of non-essential and essential tenants, going deeper as far as finding out the diversification of their supply chain, the strength of the tenant in regards to credit, financial backing, as well as the real estate itself. Is it set up in a position where this tenant can succeed, assuming that it can fulfill its business plan long term? Does it have all of the measures that'll be able to succeed? Or in the worst case scenario, is it a piece of real estate that another tenant that can be retenanted can succeed? So we want to make sure that first those elements are taken care of, and then we will always want to focus on essential. So food services, everyday need type of tenants, and also we're watching very closely the sectors, and finding out which one aligns best in a long-term vision. So obviously that is a definite thing. And then I also just read within, there's either NNN REITs or one of the other REITs did have I think 35 of their properties did declare, I think, bankruptcy or some financial issues, which they took taken back. And I think they released about half of those at that point. And I think that was as of like March. So I don't know what the current status is. So all across the board, even the large big players that have large research departments and have been doing this for decades have issues, but we want to make sure that we just put ourselves in the position that we're buying one, a good piece of real estate, then a tenant good and a good lease, good protection, and as well as does it have the ability to succeed long term. So if you have all those elements in place to put you in the best position, of course it's not guaranteed. Our hopes is that, coupled with energy policies, favorable regulations, favorable tax policies, favorable trade policies, and then we at least get into a position where companies compete, and then hopefully we'll see by June where they're talking about lowering the interest rate. And I never really base anything off of that, because that's just like that's something that if we're going to be waiting for something to happen and then stall our long-term goals of finding the tool that can meet our needs, you'll be waiting forever, or you'll be just looking at numbers and never take action. So we just want to make sure that we put ourselves in a position to succeed, despite there could be some risks that come along with it. So good question there. So this already covered is how do we compete with the REITs buying everything up. So with REITs, they have unlimited capital. So they're coming in all cash, buying all these things up. So the key to doing that is you have to obtain, relationships to get off market properties. We're constantly speaking with our broker colleagues, developers all across the country, finding out what projects are coming up. A lot of these people are having a lot of conversations early. So getting in and having those relationships, and like I said, that's what we specialize in, is getting through the weeds and finding opportunities for investors that make sense. So you just want to make sure that you are kind of ready to make a move. If you're looking for something like that, usually with the off market opportunities, you have to be kind of lined up, ready to go, or at least have an idea of does this make sense, as compared to a traditional listing where it's out there and they're just kind of fielding offers from there. So again, build upon your relationships. If it's not with like a group like us, I also put it into the book, sending direct letters to sellers, cold calling to sellers, going to conferences, going to meetups, real estate conferences, and just building up your Rolodex of people that you know in the industry and other sellers, and just being active and getting out there. So, or you can cut the shortcut, reach out to us, and then we can kind of help you out as far as finding some good opportunities for you. Is it safer to buy all cash right now? Yes, cash is always going to be king. We always have been in the best position for our clients to buy with cash, because we can manipulate as far as the terms and the closing, and it's not subject to any type of financing approval or any type of reports or things of that nature. Those can get bypassed to a degree, and it lets the seller know that, okay, this guy has the ability to move things quickly forward. I can verify funds, and it's more of a quicker transaction. So that's always going to have an opportunity. But yeah, we can definitely do financing. But again, it's having the game plan in place. So what we typically recommend is reach out to a mortgage lender that you know, or ask for any good referrals, and get pre-approved and find out what your buying ability. We can send over different opportunities to your mortgage lender and say, hey, I'm looking at these assets. Where do I stack up? And they'll let you know, here's how much we can get down, so we make sure that we can get you into this and get locked in with the rate, and possibly get yourself a pre-approval letter. And that just gives you more tools in order to move things a lot quicker. And mind you, and this is kind of the thing we talk about with investors all the time, is that when we're looking at opportunities, there's other people looking at this. So our job is to try to separate the emotional side out of the investment and just to hyper focus you. So If this is something you want to pursue, we can get you to that next step. But you have to mind you have that's why we're trying to put all of these tools in place, the educational material, the book, linking you up with our referral partners to get you in the right position. So once you're ready, you can actually make that jump and then move things along. And then the next step, of course, is closing the transaction. So just mind you that both cash or financing are both effective, but they both also have their ways about it to make it the most effective, so you can be able to put yourself in the best position to be successful. And last thing, what did I have here? Let's scroll down to so the tip of the week, and this kind of goes back to my last two presentations, and I kind of it's kind of like a story that's been kind of consistent. Is obviously everybody wants the highest cap rate they can get, but at the end of the day, we want to have kind of our set game plan and have consistency. So at the end of the day, we want to make sure that we have a great tenant that can be successful, that's going to be happy, and happy to pay your rent check each and every single month. We always go back to what do you really want? Is it you want more time to be with your children, take vacations, not deal with that headache of a rental property, not deal with that property that you had to do a bunch of landlord responsibility and all that stuff? If that's the goal, utilize one of these tools of either net lease, multifamily, all these other different type of stuff to get you there. But the big huge benefit of net lease in its true form, absolute triple net, is that all of the bills paid, the tenants taking care of it, and assuming we have a good, nice corporate or very financially strong guaranteed tenant that has an absolute triple net lease, and then it can make sure that you can get you to their goal. So we want to make sure that's the main goal. Going under the hood, we want to of course focus on the tenant performance, the lease, and look and make sure that all of the stuff that the tenant is stating that they can do, you have legal authority to make sure that both are under this agreement and is going to adhere to that. So there's always, of course, work that's underneath the hood, and we go deeper into a lot of our material. So you make sure that you have your checklist and say, okay, make sure this is there. So then once we close it, then we can have that ultimate goal of relaxation because of the lease obligations will be fulfilled.
D, if you don't mind, could you just talk briefly on the timeline of how transaction that's paid all cash versus financing, how long that would typically take? Because I know that's a lot of questions I get when I talk to people on the phone. The timeline of how it would typically take there.
I mean, for the most part, they're typically the same. For all of the transactions, and once you make the offer and assuming we get everything accepted and signed, you're going to have our due diligence period, which can last from 21 to 30 days. And we have to, of course, negotiate to make sure that is, days or business days. And like I said, again, there's some minute details there. And then from there, you have a period of, sometimes 15 to 30 days on the closing. The having financing could extend that because you have to go through certain reports that the bank or the lender wants to have, such as a phase one or phase two, a survey, um, and a kind of an inspection report. And that sometimes take time and it sometimes depends on the bank. So, and then sometimes that's issues with your bank taking a while or something, that's out of our control. So we want to kind of keep a realistic standpoint of a transaction being around on the low end 30 days to up to 60 to 75 days. And we just want to have a proper estimation or a proper expectation of that going in. So if you're doing a 1031 exchange, you have to understand that, like some people will call and say, I'm doing a 1031, I have no income, and I want to get from point A to point B as quickly as possible. Then there's a lot of levers and things that need to be moved simultaneously to make sure that's happening. That's why having a team like us, having your attorney, having your mortgage lender, having your insurance, but all of these people in place and on the same page to make sure everyone's working syncfully to go forward and make this transaction as smooth as possible. Um, and then sometimes it just has to go through. We had a deal where it took an extra 2 weeks because we were waiting on the title to produce a title report, and those are stuff that's just out of our hands. But on average, we're looking at 30 to 75 days, and it could be either with financing or it can be with all cash, and there's really no cut and dry number of where that is. But if you have that expectation of that's what's going on, but obviously having everything in place, working smooth, um, is the best case scenario. But that requires a lot of synchronization and making sure that everybody's kind of on their p's and q's to make sure everything goes smooth. Um, so yeah, that's the best answer, is to say we'll see what happens, and hopefully no issues happen. So and that doesn't even account into negotiating a contract. I've been in contracts for 3 weeks where we're negotiating. We have some that is done in the same week, and it really all depends on all of the different moving parts and the different people that's involved, and it's kind of crazy, but that's where it's at with that. So good question there. But if anything particular in your situation, we can kind of guesstimate how long everything can take, and do our best to move it along. But at the end of the day, when I say moving along quickly, and obviously people want to do that, but we want to make sure it's done right and done the correct way. Because sometimes when you do move too quickly, some stuff can get lost and not done properly, and can cause you problems on the back end. And that's the number one issue, or number one priority, is to make sure this transaction is done safe, properly, legally, and to put you in the best position for safety. So that's all. That's the number one top priority, is making sure it goes the right way. So good question there. Oh, great. So let's pop in, and as you can see here, Amazon.com. Check it out. The Net Lease Playbook. If you just type it in or type in my name, Dwayne Clark, that book will pop up. I also have two available: Rethinking Wealth, which is about passive investing into syndications, which also aligned with the net lease strategy as well. So, for our presentation on how to build a resilient portfolio in a volatile market, and anyone who I never, it depends on any type of person who's looking at it, can say everything's going good or everything is going volatile. The end game is still the same as far as the process on how we look at opportunities, and does it answer our always initial goal? What do you want? What do you don't want? And how do we reverse engineer to your goal? So here, what makes a portfolio resilient? And resilient meaning, in my mindset, able to withstand any different measures that's happened. Obviously, the latest one that we had was COVID-19, and we had economic issues where businesses are shut down for a long period of time. We're dealing with high inflation. We're dealing with shutdown. We're dealing with states that have high crime. There's so much stuff that you got to think of. So the kind of insulated answer, which is not the end all be all, but what is the best kind of case scenario that you could put yourself in to make yourself successful? So number one is long-term lease agreements. So at minimum 10 years or 8 or more, but the longer the better. And the answer, and it'll be like, why not? Why not have a 20-year lease? So look at opportunities where it's extremely long. We just did one where it was a brand new 20-year triple net lease. It's like 20 years that both the buyer, the owner, and the tenant shook their hands, say, "Hey, we're gonna We're going to be in business for 20 years. We're going to pay you rent. Corporate guarantees. That could be a nuanced type of term because you have franchisees, if you're looking at, say, fast food or quick service restaurants or service tenants that have multiple of units. So we sold one where I think it has like 1,000 units, and it's actually a franchisee. They, recently got sold. I think it was Burger King to um, Burger King corporate. I think it was Carol's. I think it was.
Yeah, Carol's LLC.
Yeah, and they had over 1,000 units, and they was just continuously grow. And it's a very well run company, so that can be essentially called corporate, even though it's ran by franchisee owners. But corporate, in a nutshell, is just a very large, structured, financially stable entity that will guarantee the lease in the case of just withstanding um, you know the financial turmoils of the market. Corporate also can encompass investment grade. So you see publicly traded companies like Home Depot and Lowe's, McDonald's, Dollar General. Those are corporate as well as investment grade as far as the credit level. And absolute NNN lease structures. We talked about on the last stream about making sure to look under the hood to see what type of lease structure it is, and making sure that, in the best case scenario, would be absolute. Is it wrong? Is it bad to have anything that's double net or something that's modified? No, but favorite, if you had to choose resilient, is that they pay the bills directly and they just send you the check. So
Just, just to piggyback off this too, if it's a 10 to 20 year lease, could you just touch on? I had to talk to somebody today. They asked me if what would happen if the tenant goes dark, say 15-year lease, year two they leave, would they still be able to get that rent for the next 13 years?
yeah, so based off of the lease agreement, the agreement that they made with you, they are obligated to continue to pay. In cases where the tenant just goes bankrupt, then it goes to a whole bankruptcy type of scenario where none of their creditors are getting paid. But for the most part, if it's like a continuously running business, but that individual unit store continues to that doesn't do well, but the business still goes on, they're still obligated to pay the entirety of the lease agreement. You can negotiate, and that's a whole separate conversation post to say you can leave the building early. We'll do like an early payout or whatever, and then break it that way. But if they give you a 10-year lease and they that individual store fails, they're still obligated to pay you the the existing rent um, lease. So that's a good thing about that. So yeah, that means it's a continuation. We want to make sure that he understands that. And again, we also have to look at the actual lease and make sure that it's spelled out that way, because some cases it has some lease language that is not favorable to buyers, that it gives these tenants a way to wiggle out of it. And that's why with the resiliency, we want to make sure that we have the strongest guarantees possible. So these stores who sign these agreements, and then the language that supports this type of lease structure, they're on the hook for it. And that's why they have kind of the financial power with all of these things, where they're able to, even though that store is not performing, to cover that rent for the entirety of the term.
And safety, if it's not a corporate guarantee, if it's a franchisee that has 75 units, his question was, would they liquidate through the 75 units in order to continue to pay him rent for the next 13 years, or is it a case by case basis at that point?
Yeah, it's a case by case basis, but typically that's what it will be. And that's why if you say it's 75 units and say it had a net worth of $50 million, and they're forced to, because they're not performing, they have to now liquidate, sell their stores, sell their assets in order to pay their obligations. Because mind you, the lease agreement is an obligation to you. So they have to pay their rent. No different than when you are renting an apartment, you have to pay. So that means if you have to go sell your furniture or whatever it is, because you made a agreement. But also you have to look in there to the arbitration laws on how that's going to be remedied. Of course, the language is going to get spelled out in the lease, but essentially that's what it is that it has the financial ability to continue to pay, even though that store should, and it because we kind of look at it in a weird way as like the store in its own ecosystem. Yes, the store receives business from customers. They then pay their employees. Then they have money to pay rent to you. But in essence, the money is coming from the corporation, and it's part of their their revenue and how they distribute to pay their expenses for their business, which then pays out each of the rent for each of their locations. So it's going to come from somewhere. But yeah, essentially, that's what we're looking for. That's why we want to look at the best guarantees we can get. So if we can get a corporate or very large, um, franchisee with 70 plus units, it's going to guarantee you for that existing year. And of course, obviously, we want a really great store because we want to make sure that the place that is of subject of the subject matter is supporting itself and is not pulling money from other operations, which then would weaken its overall ability to sustain as a business. The three tier risk filter. So this is, like I said, an always ever trending stuff. So we deal with essential. The one that we were just referring to, I think that was fast food that we were referring to that investor's question. So dealing with essential, what's essential? Everyone has need a place to sleep. You need food to eat. Even when we was going through COVID and recessionary issues, people still go to McDonald's. People still go to Burger King, Taco Bell, Popeyes. There's always going to be a market where people is going to go eat that type of food, as well as getting toilet tissue and milk and cheese and bread and all the essentials. The second part of that is investment grade. If you can get opportunities to look at that. So investment grade tenants are tenants that have triple B credit or above. And if you're looking at from either S&P or Moody's, or Moody's have a different credit tier, and the credit is no different than your credit score. So all these businesses, they just have a different modality of how they rank them. But anything that is B, triple B, I think it's either triple B or triple B plus, is considered investment grade. So these are companies that have a healthy balance sheet, so they don't have a huge amount of debt. They have a significant amount of assets. They have a significant amount of cash on hand, and then they have a trending amount of sales that is projected. The good thing about these are most of them, if not all, are publicly traded, so we're able to physically see their financials and just kind of analyze. And the good thing is, I love reading a lot of this stuff. We put a lot of alerts, and I'm reading a lot of these different stuff, and just this is curious on how these businesses operate. I was speaking with a colleague earlier today about supply chain, and this is what we alluded to last week, is about the diversity of supply chain. Are they overly heavily reliant on foreign supply chain, or do they have a mix of stuff that are local, a regional, or a couple states off? So then you're able to fulfill as well as maintain pricing competitiveness to keep you in business and move your business forward, and not have undue pressure from outside forces. Or if any administration, this administration or other administrations, propose different policies or different laws, that they have kind of a plan B to make sure that their business is somewhat insulated in a way. So we look at it at multiple tiers, but if you stick to essential, investment grade, and again, these are all if you can have your cake and eat it too. But we want to look at obviously different opportunities. So if you see something that says a franchisee or investment grade, both are good. We just want to look at the dynamics and make sure that overall doesn't meet your objectives. Regional brands with proven unit economics. So we just mentioned that earlier in regards to, because can that store support itself? So we're looking at rent to sales ratio, to make sure, does this store make money? You know, it's that's really the best indicator that they're going to be able to pay their bills, is that you can actually physically see the unit performing well. Does it have a high amount of debt? I've done several amount of sale leasebacks, and so I've been able to review financials and just run it before their before tax income, and then measure it with any type of national sales statistics. What is the rent per square um, the rent levels in that local market? Are they paying too much rent? If they have able to negotiate a moderate or even below market rent, that's a good thing. And then the fact that it has relatively market level rent bumps, which is typically about 10% every 5 years. But I've seen tenants will negotiate lower, which again is not in the high side to give you in the hedge against inflation, but also it does allow the tenant to move forward on a long term basis, which also can add some value as well. But we got to measure the numbers to see if that makes sense for your individual situation. This tier three, we have a local and short term deals and higher yield and higher risk. So again, we talked about that earlier again about people chasing these high cap rates. Everything's relative. So we would then want the ability to collect as much rent and get the highest level we can possibly pull from the tenant, but also at the same time we want to make sure that it's realistic and supportive of the tenant's business. So we'll see kind of smaller unit, or kind of 1 or 2 unit excuse me, franchisees, where they'll have to offer a higher cap rate in order to get a buyer to take over the real estate. But what that equates is to higher risk. So because it's a higher cap rate, even if it's in a really good market, still doesn't mean that it's a good deal, because they can be paying an exorbitant amount of high rent, put themselves at high risk, which then doesn't give them much wiggle room. So any issues that go on, and then they lose their ability to pay the rent, and then they don't have as many units, they don't have a high net worth, they can't support the store. So then typically you're not going to have really strong ability to recoup your investment, because they'll end up going under. So we have to look at it from a case by case basis and make sure that the operator, the net worth of the operators, um, as well as the rent to sales ratio, the rent in the local market, are kind of in conjunction with each other, to make it sure that it can, you know, do well in the long term. Because again, we're always looking at this from a long term perspective. We're not looking at it from a speculative mindset where we're trying to get in and out of properties, and that never really works well with net lease anyway. Um, because if you're looking at just trying to flipping properties where the market cap rate, it moves slower than say residential, then and then to find a buyer with your lease term burning down, it's just going to be a hard sell. So always look at it from that perspective, just to make sure that it makes sense for you. So the geography, extremely important. Um, so on Thursdays, and we haven't released a report in quite a while, we're going to be doing a new kind of educational outreach, which will be touching on individual markets. So we'll start with kind of the top markets that we prefer, where all of our clients are looking to invest, such as Southeast, Midwest. And the reason why is because population, people are going to these states, going to these local markets. Businesses are moving over there. They have um, friendlier landlord laws. They have is a business friendly environment. They have reasonable taxes and regulations. So it's built for opportunity. And again, we want to go into a playing field where everyone wins. So you want the tenants that's going to be there, they're going to do very well. And for you to go in there and get favorable treatment as the landlord itself. Big key thing is that we see there's a lot of overbuilding in some markets. So you want to keep an eye on that. And that's going to be in some suburban markets or in some rural markets. But I did a presentation a couple years ago, and I'll kind of redo it. I did it based off of multifamily, and it's the same type of metrics that we look at. Is that what are the mechanisms for a good market? And I, mentioned a little line right here is employer base. So one of the areas we had looked at was in Southwest Florida, where we have businesses moving in here left and right. We have apartment buildings, which is people get places to live. Then you have all these different tenancies because they're going to support the employer base. And then you have all these other regional businesses expanding and all these different businesses that are relocating from higher tax, high regulation states over to other places that make sense. And Florida is a big benefactor of that. So just kind of keep an eye on that. But if you're looking at several states, just reach out to us. We can kind of give you some suggestions of some markets to take a look at. And also, we're seeing a lot of activity from our developers where they're starting to get calls from these franchisees and these corporate tenants and say, hey, we want to get into these markets, and then start building there. So that's a good indicator that everything's looking good, and you want to make sure that you have an opportunity to take a shot at these markets.
Considering tenants like Dollar General who specialize in more rural markets, what would you advise investors who like Dollar General, but typically the demographics aren't always that great? What else is there to look at for them in those specific markets per se?
Well, I mean, Dollar General is a big, smart company. So, and I want to characterize as the, these secondary, they already know their business model is their consumable products, milk, bread, cheese, toilet paper, dollar store, affordable items. And typically, if Dollar General go into a rural market, they're the only essentially grocery store and convenience store in town. So for some players, so for some investors, they may be comfortable for it. But yeah, we have many conversations of investors saying, "Yeah, I don't want to be in those markets." But you just want to look at where, but Dollar General is also expanding extremely rapidly. So you want to look at where they're moving that are favorable, possibly areas of growth. So we look at the census, which again is not like the most accurate, but it does give you a good sense of the track of where population growth is happening. We tend to call into the local cities and states. I mean, the local cities and counties, and find out what's their 5-year plan, what new applications that are getting from developers and business owners about moving into the area and opening up space. What are their zoning laws they're looking at? If they're expanding in different. So you can kind of see where a market is going over time. And since we're investing for the long term, yeah, it may be say, hey, it might be a tertiary market right now, but it could be rapidly expanding. Because mind you, we're really just really concerned with does the tenant have the ability to do well and pay you rent in the long term period? So unless you're going to be like looking to sell it within a year, we're trying to look at a longer investment horizon. So if it's either and also to add into that is that looking into those types of markets, you can get more favorable pricing getting into it rather than going into a top MSA market where you're going to be paying a top cap rate. So those little tertiary and secondary markets will have a lower rent per square foot as compared to say a Miami Metro or one of these larger MSAs that will have a higher, and there's not really much room you can wiggle from. So that means the tenant will have to be killing it with the business. So we have to look at just all of the combinations. But in general, yes, I want a stable, I want a growing, I want just like, a handful of people living there, obviously. but at the same time, there's a lot of factors that's included. So really, it's just so many of them on there, and we look at so many of these deals, and I've sold from top markets to little small towns, and like they're doing well. So it really is just a case by case basis. So we just want to make sure that you look at the deal with a clear eye and looking long term in the horizon. I sold a deal where it was like a 2 lane um, road, and the street was expanded, and then they rerouted traffic, and then there's a whole bunch of now traffic going directly to that site. So that real estate got significantly more valuable because now they're getting a lot of street traffic, and then a whole bunch of other businesses built there because of that, because it's more business coming in, and then all of a sudden that whole area is busting. Another quick tip is, and this is on the micro level, is that when you're looking at real estate, I'm very bullish on tenants that are near grocery anchored, and again, like these anchored type of tenants, like grocery stores, neighborhood markets, that have all of the stuff that people have to go on a weekly, if not daily basis. So if you have your tenant that's near there in a strategic location, they can pick up a significant amount of business, because they have to go into either to or from work. And that's a whole nother deeper level of analysis to make sure that which side of the street, where's the business growth, where the businesses are locating, to see that, ultimately will be a good fit for you. So that's a good question. But like I said, we always look at it from a macro and micro level, and then look at it from the overall picture and seeing what makes sense. Three key metrics to watch. So people are kind of repeating this: rent to sales ratio. So we'll make sure that the tenant, the business is supporting itself, and you could just run that calculation based off of the sales and how much the tenant is paying in rent, and they'll give you that number. So that lower number is better because it's letting you know that it has enough money from sales to cover its rent and its expenses, and to pay rent, all of that stuff. So we want to make sure that it's a comfortable ratio, that it can give you a good indicator, not always the end all be all, but a good indicator that that store can kind of support itself. Years left on the lease, that of course has to be, we're targeting as long as possible to make sure that it's a long-term lease agreement, and assuming that will also include rent bumps as well, and the unit level sales if available. We always get this question, like if it's a franchisee, what are the sales? Give me the sales. And it depends. Sometimes they there's obligation on the lease that they have to show that, and in some cases they don't. And it doesn't make it a bad thing if that's a clause that's not in there. I had deals where they just said, I'm not even going to bother deal, and which is fair, but at the same time, in some cases it's like a private corporation. They don't share the sales. So to counteract that, we want to make sure that is how's the real estate. There's also other measures, which is not a specific measure of performance, is the traffic data. So we can find out now through cell phone data that how many people are going to this physical location. And I would assume if your cell phone is going to KFC, you ain't going there to go watch a movie. You're going there to buy food. You're going to do service the business. So in essence, I would say, and if they get people to the store and they don't leave paying money, then that's a that's a business question. Because if I'm gonna have a customer come to my store and they don't leave charging their credit card, what are they coming there for? So I would assume that the cell phone data is pretty accurate in regards to how well that store is doing. Um, and then of course we have the traffic to the site. So you have traffic counts. Where is it? If it's a hard corner location, what's the population density within 1, 3, and 5 miles? That can kind of give you some more deeper intelligence on how well the store is doing. Because again, if it has a whole bunch of people living in that area, they got the traffic coming to and driving by the store. They got cell phone data showing that people showing up in there. And if they're not performing well, then that's a whole business operator. It's just a whole nother story. And that's like, that's a whole nother world there. But we assume based off of that it would do relatively okay. So again, like it just going under the hood, like I always say, and just making sure that all of those metrics are looking pretty sound, that we can kind of conclusively say, okay, I think this is a decent investment. And is the real estate good where if worst case scenario, this tenant doesn't work out, I can replace it with another, not so similar tenant, but a different industry, a different type of business, or it gives me an opportunity to resell because it's a good piece of real estate. So again, the cash flow is king, and of course that always answers the first question of how much is cash is generating from this, and does that align with your goals of you investing into this property? And obviously that makes sure to look at the numbers. If it's an absolute triple net and if the net operating income is X, then you know that's what the cash flow is generating. Assuming this is an all cash transaction, or if it's financing, we run the numbers and see if that's relative and it's a decent return on investment for you. Um, so the I have my next bullet point is reinvest proceeds wisely and don't stretch for cap rate. So again, there's an initial cap rate. So for example, 5%, but the 5% is not going to be for life or for the life of the lease term. We assume, and we always recommend, I mean, like outside of say Dollar General and some other specific tenants, that they have some type of rent escalation built into the lease. So we want to make sure that it has there where it's going to be increasing in rent over the course of the year. So then now look at it from when you either sell it or it has a different valuation in the future. So that kind of concludes today's presentation. So I want to thank you again. Again, I generate these based off of like the week's feedback, what we're getting in questions, what type of conversations we're having, as well as what's going on in the market. So seeing that this week has been about um, the cap rates, interest rates, and where we're at with the market, that I want to kind of give some insights and clarity and see what's going on, so people can kind of get a better view of what their plans want to be. So again, if you guys go to Amazon.com, type in the Net Lease Playbook or type in my name, Dwayne Clark, and grab a copy. Since Amazon doesn't share the customer data when we sell it, just send me an email, say, hey, I just grabbed the book. Um, Please give us a review and then send us an email, and I'll put you on a specific email list that we're sending out to people to get this bonus content, um, deep dive into leases, property tours, as well as insights, talking to kind of our we call it the team, which is, our attorneys, lenders, and then kind of get more insight and be able to ask questions and make sure that you're in the right position to put yourself successfully to make things this very successful transaction. And kind of alluding to the earlier question of turning an extremely long transaction into more of a smoother transaction with the concentration of safety and making sure that everything goes smooth. We dot all the I's, cross all the T's, and make sure that you're in a position. So once you finally own it, the obligations are in place where you'll be able to get your rent checks and actually enjoy the property and get the benefits of what why you bought it in the first place. So I want to thank everybody to jumping on again. Let me just check if I had. Oh, so in closing, um, as we give you guys calls and follow up and have further discussions about what you guys are planning on doing, give you guys updates on what's going on. I know several of our clients were doing 1031 exchanges, so we want to contact us as soon as possible so we can start planning. At the very latest, at the very least, start giving you some insights with data, start studying different markets, start studying different tenants and seeing what make sense in your transfer, getting some clarity to make sure that if you're right before signing a PSA, to have the proper language so you can do the your 1031 successfully, to make sure you have your 1031 intermediary in place so that you make sure that you do not touch the funds when it transfers over, so you fully qualifies, and the full plan for it. Because once you find out what you'll be netting, how much you're going to be transferring over, are you going to be using financing, getting those conversations early, and to make sure if you do plan on not paying any boot, and boot is any leftover cash that is taxable, that you have the proper allocations so we can kind of get kind of on the right path. Um, and if you guys are in the market, reach out to us. We'll put together a custom list. Like I said, this is all we do. This is our specific niche. We can start kind of getting the wheels turning as far as putting fields out there, putting in front of you opportunities to see what makes sense, and just getting that ball started there. And finally, and I'll send a link post call, our lease review checklist. So I just put together a whole segment, which is just a one-page sheet on what you need to do as far as looking at your lease. So if you want us to walk you through that and do a portfolio review, please contact us. We can kind of check out what's going on with your property, plan for your sale, and kind of talk to you about the market, the updates, and see where it fits as far as pricing wise, and see if that's supporting your expectation. So thank you again, everyone, for joining on. Look forward to next Tuesday, guys. Look out for the emails for next week, as well as the market update for Monday. And again, see you next Tuesday. Thanks again. Take care.